This is the section that drives everybody crazy. So learning objective 11-3, understanding how to hedge international currency risk using foreign currency forward exchange financial instruments. And let's talk about some of these terms before we get into the actual transactions. A financial instrument is cash, evidence of ownership, or contract that imposes on one entity a contractual obligation to deliver cash or another instrument and conveys to the second entity that contractual right to receive cash or another financial instrument. And this is, when you were in school and they taught you how to define words, they taught you that when you define words, you shouldn't use the word to define the word. So, for example, if I ask you to define happy, what does happy mean? And you say happy means happy. Well, that doesn't make any sense. And here you can see that this is kind of hard to understand because the word financial instrument is in the definition of the financial instrument itself. But the reality is that a financial instrument could give you a right to another financial instrument. And in fact, this here, another instrument, it should be a financial instrument. So a financial instrument, when you think about it, is a wide variety of different types of agreements or contracts or instruments that have value to a company or that present a liability to a company. And again, let's go through it very carefully. Cash, we know what cash is. Cash is a financial instrument by definition. Stock, evidence of ownership, or a contract that imposes on one entity a contractual obligation to deliver cash or another instrument and conveys to the second entity that contractual right to receive cash or another financial instrument. So the example, whenever we talk about financial instruments, the definition of financial instruments is actually very, very broad. And it could include debt and equity. But when we're talking about it here, we're going to focus on one particular type of financial instrument, what's called a derivative. And a derivative is a contract whose value comes from something else that has a value that changes. So, for example, an example of a derivative that we're going to go into is a forward exchange contract, where the value of the derivative depends on the underlying value of a foreign currency. But a derivative, it could be an agreement to buy something in the future, to sell something in the future. It could be a wide variety of different kinds of financial instruments that have value. And what the FASB was trying to do here was it was trying to create a classification and then develop a set of accounting standards that would apply across the board to everything in that classification. And the FASB has done quite a good job of doing that, despite all the criticism they receive in its fair market value project. In essence, what the FASB wants you to do, almost universally, is to value all financial instruments at fair market value on the balance sheet. So what are some characteristics of a financial instrument? The financial instrument must contain one or more underlyings or one or more notional amounts, which specify the terms of the financial instrument. And let's talk about what those things are. An underlying is a financial or physical variable that has observable or objectively verifiable changes. And a notional amount is the amount of currency units, shares, bushels, pounds, or other units specified in the financial instrument. So let me translate this into English for a second and help give you an idea of why you would do this. Let's say that you run an airline and people buy tickets for your airline 3 to 6 months in advance. And in order for you to sell tickets on your flights, you need to have some idea of what the fuel cost is. Ideally, what you would do is you'd remove all uncertainty revolving around fuel costs, because the thing is that if fuel is too expensive 3 months from now, you would need to charge higher prices. But people are buying the tickets now, not 3 months from now when you're going to need to buy the fuel. So what you'd like to do is you'd like to enter into a contract to buy the fuel. You'd like to enter into the contract now in order to buy fuel in the future. And this way you know exactly how much you're going to pay. That transaction is called a derivative. It's called a futures contract. And let's talk about that in these terms. So that would require, or let's talk about it in these terms rather. The underlying here would be the value of jet fuel. The notional amount would be how much jet fuel is needed that's contracted for in these contracts. So the derivative is going to have these two features to it. One is a price that you're going to pay for the jet fuel and that you can keep track of, so you agree to that price. And then notional amount would be how much dollars you need to pay and how much jet fuel you're going to get in exchange for that. And the financial instrument could be set up in such a way that this is the average price that's expected to be valued for the jet fuel in, let's say, 3 months. So therefore, the contract is pretty much free, even though you're obligated to pay it. Again, why is it free? Because everybody expects that jet fuel is going to have this value in 3 months. So it's perfectly reasonable to enter into a contract now to buy the jet fuel later at that price. If the value of jet fuel goes up, then you're going to have a gain and you actually made money on the contract. If the value of jet fuel goes down, you're still obligated to pay that price and someone else is going to make money on it. So in a way, the person at the other end of the deal is taking a gamble that the value of jet fuel is going to go down, and you're taking a gamble that the value of the jet fuel is going to go up, and you could look at this as kind of like gambling. 3 things about derivatives. First of all, the contract needs to require or permit net settlement. What this means is that the counterparty has the ability, the party to the contract and the counterparty, that's both sides of the contract, have the ability, instead of delivering jet fuel at a certain price, to give you the price difference. So let's say that the agreement is, I have no idea what jet fuel goes for, but the agreement is that you were going to pay $10 for whatever the quantity is of jet fuel. I don't know. And you could buy the jet fuel, but that's a pain in the neck because you have to actually take delivery. They have to deliver the jet fuel to you, and you have to get it wherever the plane is that needs the jet fuel. And that's kind of a pain in the neck. So what you could do instead is you could arrange just to exchange the money. So let's say the agreement is that you're going to buy jet fuel for $10, and the prevailing market value on the date when you have settlement was only $9, meaning that you lost money on the deal because at that date, jet fuel is going for $9 and you've agreed to pay $10. But this is a binding contract. You can't get out of it. Therefore, do you actually have to buy the jet fuel for $10? No. Instead, what you could do is just pay the counterparty $1 and then buy the jet fuel wherever you want for $9. And you've gotten what you wanted. Now let's take a different situation, a situation where the prevailing market value is $12. In this case, you got a good deal because you agreed to pay $10 and now it's going for $12. In that case, the other person would pay you $2 and then you can go and buy jet fuel for $12. Use the $2 to buy jet fuel for $12, and you've in effect only paid $10. It could also provide for delivery of the actual asset that puts everybody in the same economic position, or allow the contract to be settled net by a market or other mechanism outside the contract. In essence, what we're saying is that you don't have to actually deliver the jet fuel itself, but rather you can do it, you can handle the difference in value financially so that you don't have to bar with all the technicalities of delivery. This is where hedges get very strange. One of the primary criteria for hedge accounting, and so basically there are two criteria in order for a transaction to qualify as a hedging instrument. And the first one is, and this is very strange, you need documentation. Now, you say, oh yeah, documentation, fine. But think about this for a second. Everything you've ever seen in financial accounting, no one's ever told you that you need to have documentation. It's just an assumption that you're keeping track of what you're doing. For hedge accounting in particular, you must have what's called sufficient documentation at the beginning of the hedge term to identify the objective and strategy of the hedge, the hedging instrument, the hedged item, and how the hedge's effectiveness will be assessed on an ongoing basis. And that means you have to have this documentation. And it could mean that you've done all of these things, and the hedge you know what the objective was, you know what the strategy was, you know what the instrument was, you just know it. And the hedge was effective and it worked. But if you didn't have the documentation, then it's not a hedge. And therefore you can't take advantage of the FASB's hedge accounting provisions. It's a very strange requirement, and there have been cases where companies have had to take billion-dollar losses to their income statement because they didn't do the documentation right. I believe Apple was one of those companies where they had a huge loss, at least 8 or 9 figure loss. 8 or 9 figure loss. They had to hit the P&L because they didn't do the documentation properly. So you have to have in that documentation how the hedge's effectiveness will be assessed. And then you have the hedge must be deemed to be highly effective. Because remember, what the hedge is doing is it's offsetting some kind of risk. So you must document the hedge term for how long a period, the objective, what is the risk that you're hedging against, the strategy, financially, how is this supposed to work, what is the hedging instrument, that would be whatever derivative you're playing with, the hedged item would be whatever it is, let's say in this case it was jet fuel, and how the hedge's effectiveness will be assessed would be some kind of financial test to make sure that the value of the hedge and the value of the offsetting hedging instrument are offsetting each other effectively on an ongoing basis. So this means you're going to have some kind of way of evaluating the hedging instrument's ability to generate changes in fair value that offsets in value of the hedged item. You don't have a bullet point here, but there's also a similar thing for cash flow hedges where the hedging instrument is going to generate cash flows or require cash flows that will offset cash flows from the hedged item. Now again, if you don't meet these requirements, you can have a cash flow hedge or a fair value hedge. If you don't meet these requirements, and the big one is the documentation, and it must be highly effective, tested as highly effective throughout its term. If you don't meet these requirements, then the FASB will not allow you to classify this as a fair value or a cash flow hedge, and therefore you just have two transactions. You have the underlying transaction, and you have the hedge transaction, which is just deemed to be some kind of derivative that you own that needs to be marked to market. So what is a fair value hedge? A fair value hedge is designed to hedge exposure to changes in fair value of some kind of asset or liability on your balance sheet, like available for sale securities or what's called a firm commitment. What is a firm commitment? The most common firm commitment is something called a purchase obligation or a take or pay contract. This would be an example when you've entered into a contract with a counterparty to buy or sell something at a certain price in the future. When we talk about forward exchange contracts, these are usually tradable on some kind of market or exchange. But it could also be a situation where you simply, something as simple as an order to buy merchandise or to sell merchandise, an agreement to sell merchandise at a future date, at a future price, would be considered to be a firm commitment. And the thing about this is that when you enter into one of these agreements, like a take or pay contract, it needs to be binding. In other words, you've entered into a contract to buy something, and if you've agreed that as part of the contract, if you don't buy it, you're going to pay a penalty. Or if you decide not to sell your customer something as of a certain date, you've agreed to pay a penalty. That's called a firm commitment. It's a take or pay contract. And if it's a money-losing deal that you're contracted to go into, if you've deemed it to be a money-losing deal for one reason or another, then it's a liability. And there are other situations where it's actually a money-making deal, and you can actually mark that to market value and record an asset. So the net gains or losses on the hedged asset are going to be recognized in current earnings, and they're going to offset whatever the other side of the transaction is. And between the two, between the hedge transaction and the hedge, the gains or losses should offset each other, and there should be no actual impact on earnings. The FASB's, and this is how I like to explain this, because it can be very confusing and intimidating. In essence, the value of one goes up, the value of the underlying, let's say it's an available for sale security, increases, then the value of the hedge should decrease, or the value, or it should be a liability in the other direction. The value of the asset of the underlying goes down, then the value of the hedge goes up, and they're going to offset each other. So if you have a gain in one, you have a loss in the other. And the FASB treatment as a hedge means that these two transactions actually become like one, so that you're allowed to offset the gains and losses and offset the effects on your balance sheet also, so that equity is not changed. So the benefit of having a fair value hedge is it takes the hedge and the hedged item and kind of combines the gains and losses together so that there's zero effect on income. And this is kind of how the book explains it. You have the hedged item, which is, let's say, an available for sale security, and you have a derivative instrument, which is designed to offset it. So if the hedged item goes down in value, the derivative is going to go up. You'll have a loss here, let's say if it's an asset, and you'll have a gain here. They'll offset each other, and then there's no impact on earnings. And it could go in the other direction, where the asset increases in value, the derivative decreases, and then again, no effect on earnings.